Okay, time now for Commodities Corner with Andrew Bell. Andrew Bell, you've got a great interview lined up.
That's right. Executives from the resource sector getting together for the 26th annual CIBC Western Conference. It's in Whistler. It's going to run to the end of the week. One of the companies showing up there, Alamos Gold, which just reported record quarterly production. We've seen that stock rallying about 60% or more over the past year. And we are joined by John McCluskey, the CEO of Alamos. John, great to talk to you again.
Nice to be here. Thank you.
Just want to remind the viewers what you're all about. You've got two mines in Ontario, Island and YoungDavidson, and then you've got Mulatos in Mexico. CIBC reckons, though, that about 2/3 of the value of the company, maybe a bit less, is in those two Ontario mines. So they're your core assets.
Absolutely. I think it's closer to 80% of our net asset value is now based in Canada, and a little bit more than that in terms of our production. So we're very much a Canadian-based and Canadian-focused company now.
Is that popular when you talk to investors? Do they big investors? They say, "Yeah, we want a safe jurisdiction," John?
Indeed, Canada has really come up in the ranks, and as the world has become an ever more dangerous place, investors are shying away from investing in those companies in the riskier jurisdictions. So it's a good idea that we're here. And, we took that turn about 7 or 8 years ago. We decided to focus on Canadian projects, and we've come a long way in a short time.
So if Mark Bristow of Barrick phones you up and says, "Hey, John, do you want to invest in my new mine in Pakistan near the Iranian and Afghan borders?" would you be interested?
Yeah, companies like Alamos and Barrick are like chalk and cheese. They've got so much more scale, and they're so large. They need to take more risk, and they're doing what I think their shareholders expect them to do. But for Alamos, we're smaller, we're more nimble. We're going to operate a few mines, and better that they be located in places where, everybody can sleep soundly at night.
That's right, yeah. Places where you'd go on holiday, maybe, yep. So your production there last year, hitting 460,000 ounces, you might get above the 500,000 this year.
Yeah, we're aiming for 500,000 ounces this year. We're actually, planning on being in excess of, well in excess of that by 2026, when we're finished our expansion at Island Gold. That'll take us up well over 600,000 ounces a year.
You're debt-free, I believe. Is somebody, surely you must be a takeover target at this stage.
Well, you can argue we're a takeover target almost any stage, but right now, with the market heating up and investors focusing more on the gold space, clearly we're one of the companies to watch, and I have no doubt that there are several of my peers that are likely having a look at us, but there's nothing formally going on. We're just sticking to our business. We've got a lot of work to do with the big expansion underway at Island Gold, and still, wonderful discoveries unfolding both at Island Gold and in Mexico right now at our new PDA discovery. So, the company is well positioned right where it is, and I think there's a lot more value to come. Our costs are going to continue to decline. Our production's going up. So we're in a great position just as we sit.
Tell us, costs going up across the industry. Tell us what's the biggest pain in the neck in terms of cost increases.
By and large, the gold producers are price takers. We can't very well do much about the fact that labor costs are going to go up. That's just happening. We can't do much about the fact that fuel prices go up. This is an industry that for a long time, especially the larger open pit mines, they're heavily dependent on fuel prices, and those are difficult things to control in an inflationary environment. But the only thing you can do against that is to focus on productivity, and I think that's what we're doing as an industry, and that's what Alamos has been very successful at as a company.
So I think we have some footage of your YoungDavidson mine in Ontario. Remind us, because that has a rich history, doesn't it?
it goes back a long way. It started production back in the late 1930s, produced through the end of the 1950s, and then closed down for the longest time. It was reopened again as an exploration project by Northgate, and then it went through a couple of hands, and ultimately, when we took over Orico, it ended up in Alamos. But at that point, it needed quite a substantial investment in order to turn it into what it is now. And what it is now, it's producing 200,000 ounces a year, and it's generating $100 million a year in free cash flow. And I don't think too many people would have expected us to achieve that when we acquired it back in 2015. It took us a few years to finish the development of the lower mine. But when we did so, it really came together. We increased throughput from 5,000 tons a day to 8,000 tons a day. And suddenly we had the economies of scale working for us, and it's turned into a beautiful mine.
So your all-in cost this year across the company will be a bit more than $1,100 an ounce, all in. Now, I mean, that's in line with that's in line with the global industry, but you're not like one of those super low producers that are below 1,000.
No, we've got some higher cost production, some lower cost production, but when you're quoting our all-in sustaining costs as you are there, you've got to factor in the fact that we're pouring in a lot of capital right now to our Island Gold expansion. You know, we're investing $700 million into that expansion between now and 2026. So that inflates our all-in sustaining costs. However, the actual operating costs are not only relatively low, but they're also going down. And even our all-in sustaining costs as we near completion of our expansion over the next couple of years, you're going to see our all-in sustaining costs come down as well. So we're sitting around $1,150 this year, but over the next 3 years, you're going to see us decline to below $1,000 an ounce. So at these prices, obviously, that gives us very healthy margins.